Ben, what's going on, man?
Hey Kevin, how are you? Thank you so much for having me. I'm so excited for us to be here. I've been a fan for a long time.
Appreciate it, man. I'm looking forward to talking with you today. I know that you've got a lot of insights, within your current role at LeafLink, which I believe is, I mean, I saw two titles: strategist, senior corporate development. I guess you wear a lot of different hats, right?
Yeah, I do a lot of different things at LeafLink. Mainly, my role is to help us better understand the markets that we play in. Our platform's active across 30 states. So, how do we best serve the needs of the brands and retailers across those supply chains? And I also help us manage our mergers and acquisitions activity, our strategic partnerships. Really, just have a hand in a lot of different places here at the company, but it's been nothing but fun. So,
Yeah.
I love it.
And for those that are listening that may not be familiar with LeafLink, I mean, you guys are a major player, particularly in the B2B, kind of wholesale space, right? So why don't you talk to people or let people know about what the company is all about, and then we'll dive into more specifically, your role and talking about the various, functions that you serve.
Yeah, thanks for asking. I would think of LeafLink as the commerce platform of cannabis. And our mission is very singular. And our job is to help manufacturers best sell their products to retailers and help retailers best fill their shelves with products. We facilitate those transactions in a lot of different ways. We make it easy and efficient to order from invoice all the way to delivery. We help facilitate those transactions with payments, distribution, advertisements, and insight services. So, really, our job is to make it easier for the cannabis supply chain to transact from upstream all the way down and to really make it easier to be a business in our industry today.
Mm-hmm. Which is, I mean, so important, right? As this industry is continuing to just grow and evolve every single day. And you touched on some of the roles, within your title and managing industry research, mergers and acquisitions, strategic partnerships. So let's kind of dive into each one of those. Talk to me a little bit about some of the industry insights that LeafLink has. I mean, I would imagine you're working with all the, like you said, you're facilitating the supply chain, right? And you're making that happen. So tell us a little bit
Yes.
about what data you have.
No, thanks. So LeafLink helps 3,000 plus brands sell into more than 8,000 dispensaries across the country in 30 states. We do about half of the total US wholesale industry, over $5 billion over the last 12 months. And what we do by managing all of these different transactions is best understand what's happening in markets and the lifestyle across different stages of different markets, best understand how the companies are operating across their different segments, and really like how pricing, volume, and mix dynamics end up contributing to that. So when we think about the market today, your dynamics are obviously very much driven state by state. But what we see here at LeafLink is markets are very cyclical in the way that they've pretty much followed a similar path over time from medical inception all the way to adult use maturity. So the way I would think about that cycle is when the state first launches, they typically start licensing with vertically integrated sales. So company will own the entire part of the supply chain. Sales are primarily supply constrained. So it takes time to drive up that supply, best build out your grow facilities and meet the retail capacity. That's a lot easier to bring on at first. Your prices are really high just because it's hard to bring on enough cultivation capacity to properly meet what you're looking for from a retail side. You have pretty limited form factor availability. So in your early markets, it's just difficult to develop a full, comprehensive, open market that has significant access, significant retailers, like enough ability for patients across the state to have access. Over time, as that state continues to develop, what we've seen through our data is you have a lot more availability of cultivation. Prices start coming down. Points of retail distribution start to expand. So either you have new licensing, the opening up of a wholesale industry, you have new form factors, all the way going to when you have your adult use launch. Once you start adult use sales, prices are typically really high at the beginning. It's difficult for a medical supply chain to meet a lot of the capacity demands that you have from an entirely new market open up to everyone in the state rather than just medical patients. We could talk about that for Missouri, right? Like the number of SKUs that we have on our platform in Missouri have decreased by almost 80% because of the stock
Wow.
outs that have been happening in the state. Yeah, it's crazy. Like You have 8 states that surround Missouri. 7 of them don't have a legal program. And the 8th is Illinois, where prices at the southern border are about 50% higher than they are in Missouri. So, I mean, demand has just been amazing. And for a company like LeafLink, where you have 10 out of the top 10 brands sell on our platform, 195 of the 196 stores have purchased on our platform in the last month. We got a lot of data and understanding on what's happening in those markets. And over time, as you go through your adult use maturity, you start to bring on a lot of cultivation capacity. Ultimately, like, you have the market conditions that we've seen in a lot of states today, where you don't have enough demand to meet the supply that's built up. You get extremely oversupplied conditions and prices start to fall. So we can go and jump into any state and look through what their path on maturity curve has been. But almost every single state has followed it, where you start out as a market, prices are high, limited participants, that very quickly grows over time into a more mature conditions where it's difficult to achieve profitability. You have a lot of distress, and ultimately, like, there's a lot of business failure. So it's been interesting to see that dynamic play out across a lot of like the legacy markets, like a California, Colorado, Oregon, Washington. What we've seen on our platform very positively is over the last 6 months, prices have jumped significantly across the supply chain, which has made operating health a lot higher. Like in California, we've seen bulk prices almost double. In Michigan, we've seen the price of bulk distillate increase by 5 times over the last 6 months. I mean, it's crazy to see some of the positive effects. A lot of it has to do with the seasonality of the industry, where you have a lot of outdoor capacity in a lot of these markets. So a lot of supply comes on towards the end of the year when you have your harvest in the summer, and then it takes time to process. But ultimately, what we find across all of these states is really just an understanding of how price, volume, and mix dynamics move. And we know these months ahead of time. A lot of retailers find them. So I feel like we sit in a really interesting place where our insights and analytics can delve into what's going to happen in a market months ahead of time. So I love sitting in a seat where I get to play with those and understand them, because it just makes me better understand all the different markets across the country.
Right. I mean, it makes total sense if you talked about like market maturity, right? And kind of the natural growth path that most of these adult use states are taking, and there seems to be commonality, right, with kind of their trend and their upward mobility. What about the current market trends that are happening in the current economic climate that we live in, right? I mean, surrounding price compression, volume growth, like you touched on. I mean, how have those played into those commonalities, in recent years?
Yeah, it's a great question. So before we go into what's happening today, I think it'd be helpful to look at like what's happened over the last 5 years of cannabis very quickly to understand how dynamics have gone to where they are. So back in like 2015, 2016, you had a lot of optimism on cannabis legalization. Like Colorado had just started as the first state with adult use sales. California was on the brink of legalizing. There was just a lot of capital that flowed into the industry. And there's really 2 places that capital went, right? You had your retail side and your supply side. So your demand for wholesale goods and your supply of wholesale goods. What happened in a lot of legacy markets back in like 2015, 2016, going through to 2018, 2019 is you had both your retail and cultivation capacity increase substantially. So it's really easy to bring on retail capacity. It's almost like a store. You have some zoning and regulatory requirements, but really you're opening up like a retail store. Whereas when you open up a cultivation facility, it takes years to properly dial in your yields, make it so that you're properly meeting like the square footage and tiering requirements you're looking for. So what happened in these legacy states is a lot of capital flew into the market. Over time, cultivation capacity continued to grow, eventually tipped over your retail demand and made it that prices collapsed. And that's why you had a lot of like issues in these legacy states back in 2018, 2019. Oregon had a processor moratorium where they weren't issuing any more manufacturing licenses. They had warehouses full of flower with nowhere for it to go. And ultimately, you just had a state where the supply and demand did not properly balance. That same dynamic has started to play out in a lot more states more recently. So in 2020, when you had the Democrats win the presidency and both sides of Congress, there was a lot of optimism on cannabis growth, legalization, and as a speculative asset, people thought they were going to get very large returns. So you had a lot of capital that flowed into retail and cultivation. But this time, instead of happening in your legacy markets, it happened primarily in your limited license states. So MSO dominated markets like Pennsylvania, in Florida, in Arizona, in Massachusetts. All of these states saw huge amounts of money go into them. You had tons of M&A activity at extremely inflated prices to today. And ultimately, you just had all of those dollars go into cultivation. And it took years for it to happen, but eventually that capacity started to supersede your retail demand. So, for instance, what we see at LeafLink is Arizona is the state with the largest wholesale price declines over the last 6 months. Wholesale prices are down about 40%. The reason for that is because you have a limited license market. So there was a lot of appetite for capital to flow into the state. The problem was that there was no square foot caps on how much cultivation capacity each license could have. So some of the largest greenhouses in the entire world are in Arizona cannabis. And it's created oversupply dynamics in a state that nobody thought would hit prices below $1,000.
Interesting.
And
And
those
just that
same
one, and just sorry to cut you off, but that one provision, right, is like what kind of generated that overproduction.
Yeah,
Wow.
exactly. And that's played out across a lot of other markets. It's one of the reasons, like, we're talking at a very fortunate time. Most of the MSOs are reporting earnings this week, and all of them are telling the same exact story. These limited license markets that were extremely appealing in 2020 have become largely oversaturated. And whether you have a medical state like Pennsylvania, where it's hard to get more medical patient demand, or in a more mature adult use state like a Massachusetts or in Arizona, there just simply isn't the same foot traffic, high prices, and high demand and mix to necessitate the high sales that people expected. So the reason underperformance has happened is simply because the capital cycle went way too much, like a lot earlier than people understood how the supply and demand dynamics would shake out. So now you've had a dynamic where it's been 5-6 years since huge portions of capital flew into the West Coast. Those markets have seen some of their capacity start to come off. I mean, in California, like, we track how license renewals go with the state. They're going to end provisional licenses this year. And when that happens, like, already the amount of licenses that haven't been renewed is about 15% of total square footage capacity in the state. That's going to accelerate very quickly. So I think next harvest in California is going to be significantly smaller than the last, and the last was significantly smaller than it was in 2021. Whereas in some of your MSO states that are more east, they're a little bit earlier on the maturity curve, but not much. That's been accelerated by increased capital. They're just going to continue dealing with a lot of these issues of too much flower capacity in the state. And one thing that a lot of people don't talk about is when you have oversupplied conditions, most manufacturers convert their excess flower into distillate. So you get into interesting situations where distillate prices fall to extreme lows. I mentioned in Michigan, distillate prices today are about $6,000 a key. Towards the beginning of the year, they were almost $1,000 a key. Like, that's assuming a price per pound of flour below $100. Like, that doesn't exist anywhere. And it's because you just had such oversupplied conditions in the state. So when I think about what's going on today, all of it has to do with dynamics between supply and demand. And we can jump into any state and go through it, because really every single state is different depending on their regulations. But ultimately, they all move to more capital, pushing on more supply, which ultimately blows prices down.
Well, that's what, yeah, I want to dive in a bit deeper about, when you talk about this oversupply conditions, like, is it exclusive? I mean, it's not exclusive to just one particular state with legislation in place. I guess my question is these square footage caps, right? Like, we talk about that provision. Is there states that are limited license that do cap? And if so, have you seen, I guess, a slower trend of oversupply? Because again, you've said it's across the board, but is there any difference?
It's a really good question. So each state has different regulations, right? And most of them have some form of a square foot capacity limit, but there's a few different ways for us to think about it. Number one, in a lot of states, those capacities are really high. So like Illinois, for example, your capacity constraint as one of like the 21 alternative care center, like the MSO licenses, is it 230,000 square feet? Most MSOs today do not have that much capacity. So in your typical mature adult use market, only about half of allowable square feet capacity is actually used by these operators. So what that means is there's still a lot of room for growth and capacity, even though they're not meeting the caps today. And that's been purposeful, right? The MSOs don't want to oversupply. They want to make sure that as much production as they have today, the goal is internalization. They want to sell everything in their own stores. That's a key. But if you look at how they think about wholesale demand, especially your larger companies, a lot of it has to do with, number one, what is the prices that you can demand for a product relative to what you sell it in your store? It's difficult to have very different retail and wholesale prices as one of the vertical operators. At the same time, in states where you have very small, limited cultivation capacities, there's ways to increase your yield per square foot. You could either do more plants in a certain area. You can stack tiers. So instead of just having one tier on the ground, you'll go 2 or 3 tall. I mean, somewhere like Missouri, for example, that's a state that has significant stockouts. There's not enough capacity today to meet demand, but it's not because the state didn't license enough capacity. It's because when you had the medical market at the end of last year, there just simply wasn't enough medical demand to meet the expectations that people had for adult use. That makes sense, right? You have 8 states worth of demand right now relative to what was like 5% of the Missouri population. So a lot of capacity that was being operated in Missouri at the beginning of this year was significantly below cultivation caps. That has been changed. Every single customer of ours in Missouri has requested some type of increase in their allowable cultivation. And the reason why is very simple. Bulk prices have tripled in the state. They went from about $1,000 a pound to more than $3,000 a pound. And that's been really interesting, right? If you're a manufacturer that doesn't have vertical cultivation, like your input costs just tripled. At the same time, no one wants to bring retail prices up too much because it's going to disincentivize their share and new retail demand that they're looking to grab. So you have this interesting dynamic in some states where prices will move very aggressively upstream and they won't cascade down across the supply chain in the same ways. And again, a lot of it has to do with regulatory structures, like capacity constraints and what type of market structure you have. Because right now in a state like Missouri, if you're a vertical operator, you're trying to internalize as much of your product as you can. Even in states that have significantly oversupply conditions, like if you're an MSO in practically any limited license East Coast state, you want to sell almost 100% of your product through your own stores just because the margins are much better. It makes it very difficult if you're a manufacturer that doesn't have cultivation or you're a retailer that doesn't have a brand of your own to sell. To find product that is priced adequately for what retail prices look like. And that's one of the reasons a lot of distress has happened in the industry. There's just simply not a good way as a non-vertically operated either brand or retailer to really maximize your profits.
What are some other interesting use cases that you're seeing in other states that we haven't mentioned? I mean, I'll throw New Mexico out there, right? That's where I grew up and I was born and raised. So what are you seeing in New Mexico and maybe others that are particularly interesting from your perspective?
That's a great question. So in New Mexico, the dynamics are very different than a lot of your limited license markets, right? It's uncapped license structure. Basically, anyone that wants a license can get one, and the state will help you go on that process from application to being granted approval. But what New Mexico does that I think is really smart is the state has made it so they can properly balance their supply and demand dynamics. Again, like that is the most important thing when thinking about these markets. How do you balance your supply and demand? We think about it at LeafLink from a wholesale perspective. In New Mexico, every single municipality is required to allow cannabis businesses. So it makes it so that your retail stores can be properly distributed across the state instead of having large density pockets. I always compare it to California, right? Like California, more than 1,000 retail licenses, but there's large parts of the state that you don't have a dispensary within 100 miles of you because it's not allowed in a municipality. More than half of cities in California don't allow cannabis businesses. So it makes it so that the licenses that actually are active are all very close to each other. So like if you go to downtown LA, all of your stores are on like a pretty small grid of a couple miles apart. Whereas somewhere like in New Mexico, you have 600 retailers, but they're all very properly distributed across the state so that you could properly meet consumer demand. Like the way I think about it is as an end consumer, like if you're looking to buy something from a convenience store, you're going to go to the store closest to you. And typically that's going to be within a 5-minute drive. For a lot of people in these states, if your city doesn't allow legal cannabis, you're very unlikely to access the legal market just because it's far away. Prices are typically higher than illicit product. And if you don't have good access, it makes it very difficult for the state market to grow. It's another state like Illinois, for example, where more than half of dispensaries today are in Chicago. Like that makes sense, right? That's where your big population center is. But at the same time, there's large swaths of the state that don't have a dispensary hundreds of miles from them. And it makes it very difficult to access the legal market from that. So that's why I love New Mexico so much. It's an uncapped license structure, which has typically been associated with large oversupplied conditions. But at the same time, they figured out that you need to properly match your retail density to meet the supply constraints that you put into the market. So if you're in New Mexico today, I think that's a market that has a lot of participants and is going to be very healthy going forward.
Yeah, I'm so glad that you brought that up too, because I mean that's been echoed on this podcast from other guests, and in addition to the issues where if you allow, like you said, cities and municipalities to have a say, whether or not they want to allow cannabis business, there's a whole other array of problems that occur right outside of the ones you mentioned from a supply and demand perspective, but also, I mean, just the taxation, right? I mean, if you look at California, for instance, you've got not only state tax, but then you've got the municipality tax. There's certain mandates in place where you can't even travel or deliver cannabis to your retailer going through certain towns. I mean, there's a lot of red tape that comes with it, and ultimately it's a detriment to the industry.
Yeah, you're exactly right. And I think it ends up having impacts on a lot of state markets. And I'll give you another example, right? Like Missouri and Illinois. It's been talked about a lot, but Illinois' out-of-state traffic has decreased over time. They've lost about 15 to 20 million of sales over the last few months, primarily because if you live in northern Missouri, it's a lot cheaper for you to go into your own state and buy product than it is to go into southern Illinois. It's the same thing for surrounding states in northern Missouri. Like it doesn't make sense to go to these southern Illinois stores because the tax structure is significantly higher than it is if you're an operator in Missouri. So we've seen in the MSO earnings, I mean, some of the large operators have reported sales down 30-40% in those southern Illinois stores. And it's because of the tax structures put on by the municipalities. Similarly, in Massachusetts, you have community impact fees, which have made it very difficult for a lot of retailers to hit profitability. I understand why municipalities want to get their fair share of the cannabis business, but at the same time, in an industry right now that's operating with negative margins for a lot of companies, it's really difficult to have to give back some of that money to the municipalities, states, and counties that you're creating jobs for.
Right. Yeah, no, I totally agree. And I'm proud to say that New Mexico is doing it right. That was one that was non-negotiable, when they were looking to push that bill was, they went back and forth on allowing municipalities and they stayed firm. And I'm glad that they did because it's working well for them, at this point. One last question to wrap up kind of this part of the discussion is, there's talks about interstate commerce, right? And there's certain states that are working to put legislation. I believe what is California and Oregon. So tell me how interstate commerce will impact this and shake these issues out when it comes to oversupply conditions, right?
Yeah, that's a great question. So it's always a lot of fun to speculate on policy. The number one caveat I have to start with is it's difficult to know exactly how an interstate policy would end up being rolled out across the country. So far today, you've had largely oversupplied West Coast states like California, Oregon, and Washington be very interested in some type of interstate agreements. The way I think about interstate commerce is you have producing states and consuming states. And going forward, like I think there's going to be some point in the future where you have like a nationalized interstate market where you grow cannabis in the cheapest locations, and then distribute it out to the rest of the country. So when I think about interstate commerce, like I think of a California and a New Jersey. The New Jersey Senate President Bob Mendoza has been very specific about they want to be a party to any of these interstate agreements. And ultimately, the reason why is your cost of production of growing outdoors in the Emerald Triangle is about 1/4 of the cost of growing indoors in New Jersey. So It makes it very difficult to compete with a lot of the lower cost production that happens primarily on the West Coast. So I think about going forward, interstate will probably exist in the country in the way that you grow in California, Oregon, Oklahoma, some parts of the country that are very agricultural and have good growing conditions. And that'll all be shuttled east to the northeast, down into Florida, really anywhere where it's difficult to have good outdoor growing conditions. That's obviously been different than a lot of the state market developments so far in a lot of states, especially where you don't have good growing conditions. Almost all of your capacity is indoors. You have very high costs of production. So it's difficult to think about how those operations will compete with like some of your lower cost outdoor grows out west. And I think that's a lot of concerns that state regulators have. How do they best protect the interests of the people in their states? But I also think that there is some future where you have global cannabis trade where we don't even know if it's grown in the US. I mean, tobacco is a great analog for us to think about. Tobacco used to be grown in the mid-Atlantic and was shipped across the US. And now most tobacco comes from Colombia and Turkey, and almost none of it's grown in the US. And I think that is similar to a lot of other agricultural products where you want to grow it in your lowest cost of production regions. And there's just significantly lower costs of production areas, even in the US, than a lot of your like indoor capacity states. So I think it'll be interesting to see how it develops, but I do think there's going to be a lot of hesitation from state regulators in states that have already built up programs like Massachusetts, for example. Almost all of your capacity is indoors. The second you have interstate commerce, that's all probably obsolete, or at least very non-cost competitive.
Right.
So we'll see how it goes, but there's many different forms and structures for interstate to end up playing out as.
Yeah, no, that's interesting. And I've always kind of thought like, when everything does kind of come to fruition, right? We're talking interstate commerce, eventual legalization. Like I agree with you, right? You're going to see those states like California, Oregon, Oklahoma they're set up with great agriculture, and then also good climate conditions, and then the big cities like New York, right, that are coming online being more of the consumption hubs, right, and New Jersey and others, just because of the population, right? I mean, there's so many people and not ideal weather, right? I mean, 8 months out of the year you've got rain, sleet, and snow. So, and I would know because I went to school in Pennsylvania for 4 years. So. Well, I want to switch gears and talk about, you touched on some of these things, but, operators basically are pulling out this recessionary playbook for this year, right? And you talked about some tactics that they're implementing that you're seeing, but let's really dive into some of them. I would imagine cutting expenses, raising margins. I mean, what are some other things that you're seeing that they're doing right now to deal with what's going on?
Yeah, it's a great question. And I'll preface with saying this isn't unique to cannabis. Across industries, across the country, even internationally, every single company is looking to how to best optimize their costs, how to best grow their revenue, and how to best flow their cash beyond it so that they can make money no matter what ends up happening in our economic climate. So when I think about what operators are doing today, it's a few different areas. Number one, right, it's optimizing costs. When cannabis was a speculative asset and people were just throwing money to grow as quickly as possible, profitability wasn't a main concern. So when we look at a lot of the operators, they try to do everything, right? People try to build out brands. They built out their own distribution assets. They built out their stores. They built out their own B2C delivery. Ultimately, a lot of operators just wanted to have a hand in the business. But now as prices start to fall and margin compression becomes a real issue, it's very difficult to do everything really well. So what I think a lot of companies are trying to do in cannabis, as they are across other industries, is narrow down your focus and focus on what you do the best. And what that means is getting rid of some of these operational requirements, headaches, and difficulties that have made it unappealing for cannabis operators to manage the entire supply chain. So there's a few different ways that we think about this. Number one is in distribution. A lot of companies built up their own self-distribution assets where they can push their brands out to the retailers across their states. That's really expensive to manage. So a lot of those self-distribution assets have been turned over and they're looking to now use transportation companies, fulfillment operators, like really companies that are trying to make it easier for big operators to manage their operations while also being able to focus on their own specific areas. Another way that operators are optimizing their costs is by improving the management of their working capital. So companies want to have as much cash as they possibly can. And the best way to do that is to manage their inventory sell through, best manage their receivables, make sure that they're not lending out too much money in like net terms to their retailers, while at the same time making it that they can continue doing business. So it's like working capital optimization is one of the keys in continuing their operations. And lastly, it's just really thinning down the cost structure. Like you see a lot of operators pulling out of states that have been unappealing to them. Like some of the big MSOs left some of your Western states. A lot of big cultivation capacity improvements were scaled back. I read something that the amount of MSO CapEx for this year is going to be down like 75-80% from last year. Like that's crazy.
Wow.
And I mean, you can see it in like Scott Miracle-Gro Hawthorne, like their sales projections are a very good line into seeing like what does CapEx and like grow equipment growth look like. And that pretty well matches to what like development of new cultivation is going to look like across the states. And it's clearly down a lot, right? Like most states' prices are down over the last year. So if you're looking to first enter a new state, it's pretty unappealing to enter like towards the later stages of the curve where profitability is more challenging, especially with the regulatory and compliance requirements. Like if I were looking to enter states as a cannabis business today, some of your limited license states that were so appealing a year or two ago are margin negative for a lot of the operators that are there today. By the same token, a lot of states that seemed almost dead in the water over the last couple of years, primarily your legacy states, like if you're a cultivator in California today, you're able to sell a pound of outdoor flower for $800 to $1,000 a pound. That's well above your cost of production, well above what it's been the last 2-3 years. Like that's a pretty good business. So I think it's really important to narrow down on like what's happening on a state by state basis and then how that best matches what cost structure you're looking to achieve. Because if you're looking to enter a new state today that's extremely challenged and doesn't have strong prospects for growth going forward, it's going to be really difficult to make a return on that investment. Whereas if you're looking in a state earlier in the curve or some of the states that don't even have medical programs today, like I think of a Kentucky, that's like the hemp capital of the world. And they're going to have an uncapped license structure starting in 2025. Like that's really interesting. It's a state that prices are going to be really high. Cultivation conditions are good. You have a lot of expertise from the hemp industry. Like I look at how operators can best manage their costs as how they can best manage their strategies of entering states. And a lot of it has to do with listening to what the data is telling you.
Right, right. Is there any other data insights? I mean, you mentioned, you kind of joked earlier, and I'm jealous of the seat that you're in because you have all this data and you kind of have a crystal ball in a way, right? Where you can kind of predict patterns and pathways, right, based on the data and what's happening. So is there anything else that you kind of foresee playing out, maybe in specific states or just generally?
Yeah, I appreciate you asking. So from our LeafLink Cannabis Wholesale Pricing Guide, we do a very good job of making sure we understand how pricing dynamics are changing across states. And like, I'll give you a prediction right now. I'm positive it's going to be right. Maryland prices are going to go absolutely crazy when legalization starts July 1st. They're rolling out an amazing program where if you're a medical operator today, it's not particularly high barrier to enter the adult use market, which is really important. You want to make sure that the medical supply chain can enter the adult use market. At the same time, you're not going to have new licenses ready to come on for a few months at least. They're going to be licensed by the end of the year. But if you look at some of your other comparable states, it's just going to take time for them to come online. So in a state like Maryland, I think it's going to follow what happened in Missouri, where prices tripled. Retail demand was very strong. And ultimately, like, Missouri is one of the winners of this year. Like that's a market that is going to be top 5, top 6 in total sales in the first year of adult use. No one would have expected that. I think Maryland, again, is going to be another state where medical sales have kind of been flat to down over the last year. Prices have been down like 50-60% over the last 2 years. But that's all going to reverse very quickly. In some other states, there's other dynamics that we're watching, right? Like you're going to have almost all dispensaries in the US come online in New York, New Jersey, Ohio and Illinois over the next year. Like in Illinois, you have your 185 social equity retailers that are starting to come on. In Ohio, you have 70 provisional licenses. In New Jersey, you have more than 300 approved retailers. And in New York, you have your 300 plus card licenses. And across all those states, that's more than 1,000 dispensaries that are going to be here by the end of the year. So when I think about those states, that's the type of like demand I'm looking for when I think about demand and supply dynamics. Like if you're a wholesale operator in any of those states I just mentioned, like things have been relatively tough today just because there's not enough retail accessibility to end consumers to juice the markets the way that people thought that they would grow. But as more retailers come online, like that demand for wholesale product and raw biomass increases significantly. And it's one of the reasons like prices in those four markets I just mentioned are definitely going up over the rest of the year. Like I have no doubt about that as well. There's just going to be significantly more demand than people talk about. Like a lot of conversation I've seen about Illinois, for example, over the last few months has been relatively negative. Like sales are starting to flatten out, to go down. This year, like in April, Illinois had its first like flat year over year growth month ever in its adult use market. That's going to very quickly turn back up the second you get all of your retail starting to come online. There's definitely been some issues like with capital constraints and difficulties like coming and starting your business. But ultimately, that's going to be figured out. And once license holders are able to come online, like these are states where in Illinois, you have what, more than 2 billion in total sales across about 100 stores. So again, a business where you can make millions of dollars as an operator without having ever running a business in cannabis before. It's just as long as you can stock products in your shelves, like you're going to make a buck just because of the way prices play in the state.
Right, right. These are great insights, Ben. I mean, you're loaded with data, man. I appreciate it. I know that the listeners definitely are as well. I want to ask you about your thoughts on the cannabis tech ecosystem. Obviously, this is a burgeoning industry. We're still growing, right? I think there's 22 adult use states, so not quite half of the country has gone legal, but we're getting close. How have you seen the tech ecosystem evolve? Like, what are your thoughts on that space?
Yeah, thanks for asking. So look, tech stacks in cannabis today are highly fragmented, where you have a lot of companies in the space that saw a really attractive industry that was growing very quickly with like large opportunity just because you don't have traditional players coming to enter. So when I think about like the Canatech ecosystem in cannabis, you have a lot of companies that are either very narrow, so they're like almost a product, or there's companies that are like a product feature. So when you have such fragmentation in the tech stack, it's really difficult for each individual company to achieve the scale required to like actually become profitable and not burn cash. So when I think about companies that I've entered in the industry, I've looked at a lot of financials. The amount that are actually profitable is very limited. The reason why is just companies aren't able to get the scale required in the cannabis industry, especially when you have your end consumers like not having large access to cash, especially today. Like people don't want to sign big tech agreements. So what's happened is that consolidation has picked up very rapidly. So like when I look at the Canatech space over the first 6 months of 2022, you only had like 3 or 4 deals. Over the last 6 months from today, you've had like 15 or 16 companies come together. A lot of it has to do with limited accessibility to cash. Like I feel really lucky that LeafLink raised $100 million back in February. So we have a lot of capital. We're looking to deploy that in whichever way makes the most sense for us. A lot of companies in the space are not so lucky that they don't have like such a large runway and cash position to manage like what has been relatively tough times in the industry. So coming from a place of strength on our balance sheet, like I look at new companies that are either looking for funding or acquisition almost every single day. And the commonality across almost all of them is the Canatech space is highly fragmented with a lot of small operators that haven't scaled their businesses to where they need to be profitable. I think LeafLink has done a great job of helping both improve and make the cannabis tech ecosystem more efficient. Like we're a commerce platform for companies that are plant touching, but we work with a lot of partners that are not plant touching. to best facilitate those transactions. So like we work with payment partners and logistics or distribution partners across states. We work with a lot of ancillaries to help them improve their businesses to make the overall CanTech ecosystem better. So I think if I were to highlight like one theme, it's consolidation. Consolidation will continue. You've had some strange bedfellows because of that consolidation. So there's been a lot of interesting deals, but almost every public deal that's been announced, we've had a chance to look at. And I mean, again, it's difficult to achieve profitability in an industry that your end consumers typically aren't profitable. But again, it's like the CanTech ecosystem is going to not only survive, but thrive. And a lot of it has to do with the learnings that we're making now before large traditional players start to enter the space. But clearly, you've started to see like a few companies really achieve scale at different points in the supply chain. Primarily, they've been downstream exposed to retailers. That's just because retailers have had better economics historically, a lot of it having to do with tax structures. But when you look upstream at software, like you have a lot of partners of ours that have done a spectacular job of making it easier for companies to manage their businesses. And I think we're like at the front of the pack on that. So I think LeafLink has done a great job of aligning with the upstream companies to help them best sell their products downstream to retailers. But at the same time, that's informed by a view that like we think that cannabis is going to continue to develop very similar to other industries like alcohol, tobacco, or pharmaceuticals, where you have a very consolidated supply side of the market with a relatively fragmented retail side. So no matter how it plays out, like we want to make sure that the suppliers in the industry can properly meet the demand of all of your retailers, while at the same time making it possible for retailers to really find the products that they need to put on their shelves and get them to themselves in an economically feasible way. So yes, the CanTech ecosystem is interesting. There's a lot more capital that needs to flow, but I feel really lucky to sit in a position where like we have the runway to continue on no matter how the industry develops.
Yeah, absolutely. I mean, and I should have mentioned that earlier. Congratulations on that raise. I did read that press release and hear about it on LinkedIn. That's huge, man. Especially like you were saying during these times. So with that runway, you guys are set up for some continued success.
No, thank you so much. Yeah, there's a lot of work on our end. We have a rock star executive team that made it happen. So I just feel really fortunate to be in a position in cannabis with some cash. But again, it's like trying times for everyone. It's difficult to be a cannabis company today. So to be able to survive this cycle and really be there for the companies that exist on the way back up, is the name of the game.
Yeah, you mentioned that you do have a rock solid executive leadership team. Shout out to Doug Gordon, who's a fellow Bucknellian that I went to school with. Yeah, he's been on the podcast before, but I have talked to the former CEO as well as one of your technology experts. So I mean, overall, you guys just have a rock solid team. And I want to ask you and leave you with this, Ben, and that is and I'm excited to ask you for this because it seems like you can tell the future with all this data you have. So future of cannabis, right? I mean, it's a pretty generic question. Like, what do you foresee the future? How do things play out? Public policy, consolidation. But I mean, really, like from what you're seeing in your purview with all that data, I mean, kind of where do you see this industry headed?
Yeah, I think obviously the prospects are very large, right? Like I think we have a long-term future where you have like a growing large global industry that properly serves the needs of both medical patients and recreational users. An industry where you have very little illicit share, and things continue to develop and mature similarly to any other industry coming online. I'm going to be like, I always want to be very honest. Like, I think it's going to be tough times in the short term. You just still have a lot of product to work through on the supply side. So I think there's going to be more pain in the short term. Like, there's going to be more businesses that go out. You're going to have more consolidation. Like, when we think about what our customers are looking to do, like, you have large amounts of consolidation where almost all of the equity or all of it is wiped out from the companies being acquired. Like that is not the conditions of a particularly healthy industry today. But as that continues to develop, and your supply and demand start to balance across states, I think those dynamics are going to improve a lot. So people remaining after we go through this next like 6 to 24 months of pain, are really going to be here with very limited supply, significantly higher prices than today, even greater demand. Like that's what I love about cannabis. Your volume continues to grow no matter what happens to prices. Like the only reason sales were actually up last year relative to 2021 was because you had so much volume growth. Like prices at retail even fell like 15 to 20%. So that mean that your volume had to be up 25, 30% to make up with that, let alone some of the mix impacts that you had. So when I look to the future of cannabis, it's one that's very bright with strong operating companies that have taken the learnings of today, best managed their cost structures, and looked into going into the future. But again, it's going to be some short-term pain to really make it through. So LeafLink's here to help both operators, both up and down the supply chain, best manage the conditions today. I think we do a spectacular job of helping companies best manage the conditions. So I think there's going to be a time when everything's great, people are sunny, and you have a lot of positive attitudes. That's definitely not today, but it's going to be soon.
More pain, but we're going to get out of it. Is what I'm, yeah. No, I appreciate the insights, Ben. You truly know a lot about in the space. I mean, and again, the data that y'all are collecting and what y'all are doing within the industry is just amazing. And so it's a pleasure. The pleasure is mine to have you on today. I really appreciate your time. Where can people find LeafLink, yourself, maybe on social media if they want to learn more?
Yeah, so our website's leaflink.com. If you're a plant touching operator, please sign up. Like I highly recommend it. It is definitely worth the money. We can also be found on any of our social media channels. LinkedIn's where we're most active. So you can either look for LeafLink or Ben Burstein. And we definitely have a lot of insights and more information to share. And I'm happy to answer any questions if you have them.
Ben, let's have you back on, man. Like, things are definitely going to evolve naturally, right? And so I really love your perspective and your insight as it relates to specific states and, growth patterns that you're seeing and all the other stuff that we talked about today. So again, thank you so much. And yeah, I look forward to the next time you come on.
No, thank you so much, Kevin. Like I've been a huge fan of yours for a long time. I love so much that I've been able to have this conversation with you. So let's definitely make it happen. And this has been great.
Awesome, man. Well, I appreciate it. And now you got a fan from me. So there you go.
Thank you, Kevin.
All right. And thank you all for listening. Until next time, guys. Bye.